This episode of Engineering the Future is brought to you by National Bank, OSPI's official banking partner. National Bank's offer for engineers just got even better, now with exclusive access to virtual healthcare advisory and legal assistance services provided by its official partners. Find out more at nbc.ca/engineer.
This podcast is brought to you by OSPI, the Ontario Society of Professional Engineers, the advocacy body for professional engineers in the engineering community in Ontario.
Welcome to Engineering the Future, a podcast presented by the Ontario Society of Professional Engineers. I am your host, Jerome James. Rising interest rates are having a profound impact on Ontario as well as the rest of Canada. Increases in mortgage payments are making it increasingly difficult for families to manage their finances. In this episode, we'll be exploring the financial strategies that engineers should consider amidst uncertainties in the current market. And here to help guide us through those uncertainties and offer some practical advice is Matthew Pickering, Mortgage Development Manager at National Bank. Matthew, welcome to Engineering the Future.
Thanks for having me today, Jerome. I'm excited to be here.
Great. Can you give us a little bit of a foundational background of what you do at National Bank?
Yeah, absolutely. So thank you for having me today. I always like to give a little brief intro of myself, just so, a lot of the time I'm the one asking the questions with customers. So it's always nice to open up and give information about myself. So I'm a father of two. I have a 1-year-old and a 3-year-old. For those of you who know what that's like, I got my hands full here, to say the least. So I'm not an engineer. I did go to school for economics, which in my opinion is probably, going to be more, beneficial for helping clients. But so right out of school, I started at a major institution downtown Toronto, and I was there for about 8 or 10 years, in different industries such as wealth management, customer service, risk management, then data and analytics. What was cool for me is I joined, the mortgage world at a really crucial time which we saw with COVID, right? So, being there for 4 years now, I've seen when rates were, as low as 1% to when we saw a 4% increase in prime to, rates today at 6%. So I've seen a lot of things over the last couple of years, and it was a very, there's a lot to happen, and you're talking to all different sorts of customers and different kind of problems, right? So what I love about my role is I get to talk to, someone first-time home buyers, learn, what do I need to know for buying my first house, to someone up to, owning up to 40 units. And so before we dive into there, I'd also just to kick off is working with engineers is always one of my favorites. So, again, you deal with a lot of different kind of customers. So engineers are, to me, a very detail-oriented client. They're asking the right questions. They're not just trying to take something for right now. They're looking at the long term.
So you have experience with working with engineers. So what are some of those questions that arise or issues that you need to consider when talking with engineers about home ownership or the rising interest rates and in turn those increases in mortgage payments?
Your average engineer is going to be pretty detail oriented and numbers driven as well, right? So they're trying to minimize any risk as possible and, still trying to keep opportunity available in the future, right? So it's kind of finding a way to understand what their current needs are and what their long-term needs are and seeing how I can help there, whether it be maybe starting to own other rental properties or maybe the goal is to pay off the mortgage as fast as possible, right? So what I love about my job is every file is completely different and it's a whole different game every time I talk to a new customer. So just kind of going through and seeing what their current needs are and providing strategies to help them with that.
Do you find that they are more inclined to go through a certain type of financial instrument or avenue?
Yeah, no, and to me, it's kind of like one of the key financial strategies I always like to do is build flexibility into your mortgage, right? So a mortgage loan is a loan at the end of the day, right? It's structured based on your interest rate, the amount, how long you've set it up for. So at the end of the day, it's just a loan. But there's certain ways that, we can take advantage of this loan to build flexibility into your mortgage. So what I like to look at is, building diversification to your mortgage. So let's say, for example, you're taking $1 million mortgage. It's no different than investments. If you're going to take $1 million, you're going to invest it all in one thing? Most likely not, right? So why not diversify your mortgage too? And what that means is we're able to portion off your mortgage into, several pieces. So let's say, for example, again, $1 million mortgage, you take $500,000 in a, 3-year fixed rate and then $500,000 in a 5-year variable rate. This diversifies your mortgage. So, when rates went up the way they did, you're not feeling as much as if you were all variable, or if rates are going to be sticking around a little longer, you're benefiting from the fix. So, everyone's slightly different, but by being able to diversify your mortgage and playing it that way is a great way to go. And even with the diversification, you can also do it by different years, right? So in that example, you're taking a 3-year fix and a 5-year variable. So that means half your mortgage is up for renewal in 3 years. So imagine if your mortgage was up for renewal this year, rates are over 6%. A couple of years ago, they were around 1 or 2%, right? So the year you renew is can be a lot. So, not putting all your eggs in one basket, by diversifying your mortgage and when you're up for renewal and what kind of rate you have is a great way to, strategize your mortgage.
Excellent. I've never heard that before. Can you explain the concept of refinancing in the context of a rising interest rate in this environment, and how it would impact the personal finances and a mortgage that someone would have?
Yeah, no, absolutely. Good question. So refinancing has actually been one of the biggest, my most volume of files this year. So what refinancing is it could be a multiple things. So let's say your mortgage is up for renewal and maybe you're at another institution. By me bringing you over to National Bank with your mortgage, that would be considered refinancing, even if you're not taking any extra funds. So refinancing is more or less you're redoing your mortgage. The benefit of refinancing too is maybe, let's say you're either an existing customer or you're looking to do something, is you can consolidate debt. So consolidating debt is a very big thing with refinancing. And, for the customers that have been putting on, credit card debts or unsecured line of credits or have our loans, they're paying a lot higher interest given what, even despite what the mortgage rates are now. So we'll go through a refinance application and consolidate sometimes, anywhere from $20,000 of debt to almost $200,000 worth of debt. We do our analysis to say, okay, based on this debt we've consumed in the mortgage, you're now saving X amount monthly. So, despite the rates being higher, they're still going to be lower than what you put on your credit cards or anything like that. And to me, to be honest, sometimes refinancing has a bad name out there. I think some people think refinancing is oh, maybe I have to break my mortgage, which isn't the case, but it's more so it has a bad name. But to me, I think the problem is putting on that level of debt. So when I help customers refinance, we're consolidating into their mortgage. We're getting it all cleaned up. And the problem to me is if next year they call me back again saying, hey, I just put on another, I'll just say 100,000 of credit card and line of credit debt. Well, we're back in that situation. So we may have not set you up for success. So it's also planning based on your income versus your expenses. And that's where, refinancing can help you, but we want to make sure we stick to what our plan is.
Excellent. What considerations should engineers keep in mind when deciding between a fixed rate and a variable rate mortgage to best manage their finances in these uncertain times? And I know you were pointing to something that was a mix of the two. And if you want to elaborate more on that.
Yeah, absolutely. No, absolutely. So, fixed and variables always been a debate despite what the rates are today, right? So, and to me, it really comes down to your risk level. So, variable is going to change. Our payments change when prime changes. So when the Bank of Canada announces there a change, your mortgage payment will change. So there's a lot more, there's more risk to it just naturally, but there's also more benefit to it as well, right? So with variable, you have the options of locking into fix at a later date. So we offer a 5-year variable. Let's say you take the 5-year and, 2 years go by, you can now lock into a 3-year fix if you want, as long as the remaining term is equal or higher of whatever, your original loan was. You can always lock into fix. So there's some benefit of the variable. Typically, your variable is going to have a lower penalty than fix. Their penalty calculations are completely different. Fix is going to be based off of, so if you have a fixed rate mortgage and you're going to break it, it's going to be based off of what your balance is. What's your remaining term? So let's say you take a 5-year and you want to break it in year 2, it's going to be higher penalty than if you break in year 4. And then what's the interest rate differential? So that means what do you currently have as your interest rate? And then what's the rate available at time? So if you're trying to break your mortgage to get a lesser rate, you're going to have a higher penalty. If you're trying to break your mortgages and rates are higher than what you have locked in, the penalty is going to be lesser because you're taking a higher rate. So fix is just based off a calculation and it's constantly changing based on the point of time. Where variable is just 3 months of interest. So it's consistently 3 months of interest if you break in year 1 or year 4. It's going to do that too. So my thing is always understanding the client and understanding their needs, right? So it's, to me, what is their risk level? If there's someone that's not going to sleep knowing their mortgage payment may go up or down, then fixed is probably the right tool for you. And naturally, you do pay a little bit more interest on a fixed rate mortgage just historically, but it's the safety net of knowing my mortgage isn't changing for the next 3 years or 4 years or 5 years. And now I can build my planning and my savings around what I know my expenses. So it's understanding what their risk level is and also understanding what their next steps are in life. Let's say I know they're going to be moving in 1 or 2 years. Do we want to lock into a 4-year or 5-year? Probably not, right? Maybe we want to line it up with their move. Or let's say, for example, I know they're going to go from a salary employee to a self-employed. Well, we know, we need a 2-year history for self-employed. So maybe we want to, buy that time with your mortgage. So it's getting to understand what their plan is and then providing that advice that best tailors them. And like I was mentioning earlier, you can always diversify your mortgage by taking multiple portions. So that's just something, and it's not like one's ranked higher than the other. There's still the overall mortgage held at National Bank, but they're just portions, which allow you to kind of diversify, again, but not put all your eggs in one basket with interest rates and terms.
So that's an interesting concept of going from being an employee to then being a small business, and how that affects your decision making on the type of mortgage that you're going to take.
Absolutely. No, and same idea with retirement, right? If someone's looking to retire, you want to plan ahead because they might not qualify before they retire, right? Or after they retire.
Interesting. Let's talk about risk management. How does this concept apply to mortgages? Like just from like a textbook perspective?
Yeah, and in having a risk management background, again, it's multiple things. So it's, again, diversifying your mortgage, like I mentioned earlier. Even if, for example, you have multiple properties, it's diversifying all your mortgages. So are all your mortgages held at one institution? Are they all going to be up for renewal at the same year, right? So finding ways to build flexibility there. But also like building flexibility can be with your current, let's say you just have one mortgage. There's a lot you can do there too. So one of the things with right now is when you're going through an application is there's a term called your amortization. And this is the amount of years it's going to take you to pay off your full mortgage. So you're going to take a mortgage term, let's say a 3-year, 4-year, 5-year, but your amortization is how long is it going to take? So the highest we can go is a 30-year in Canada. So by being able to use, that as a variable in our calculation for your mortgage payment, a lot of people right now are extending their amortization to 30 years. That just means it's going to take you the full 30 years to pay off. And so people are like, well, I don't want to re-extend it. I want to make sure it's paid off early. You're able to change your amortization anytime you're up for renewal or going through refinance. So let's say you're taking a 3-year fix, you can change it to whatever you want in 3 years. So by being able to extend it to modify your mortgage payment to get it lesser will build you time when rates are high like right now. And we have certain clauses in our mortgage agreements that allow you to pay off your mortgage faster. So despite us extending to 30 years, you're now, you can take some advantage of some of these clauses to pay off faster. So for example, let's say you have 20 years and your monthly payment's very high because it's a high rate and you have 20 years left. What we can always do is extend it to 30 years and then add an optional payment to get you whatever that difference was. So if you're, let's say you need an extra $700 to get you back to that 20 years, we can extend you to 30 years, add the optional payment of that $700 in this example, and then we know you're paying off in 20 years. But the benefit of this is if anything ever happens to you, let's say, for example, jobs change or income levels are changed, maybe there's a pause in something there, you can always cancel this optional payment. And now you've reduced what you owe per month. Or if you keep it at a short amortization, you're mandatory to pay that amount every month and there's no flexibility there. So if something happens and you now want to extend it to 30, you have to either refinance or you have to wait till the end of your term. So you don't really have as much flexibility.
Wow, I didn't know that was an option. That's a really interesting peace of mind type of tool.
And also to add with risk management, right? There's a lot we can do there. So a couple other things is, let's say, for example, you're buying a property and, to me, risk management is what do I have as a safety net available? If I'm putting all my savings towards this new property, what do I have available, right? So for people looking to put maybe 22% down payment versus 20%, let's do the numbers. Let's run the numbers of what your payments are going to look differently. Maybe it's worth keeping that extra 20, 30, 40,000 in your savings if your monthly mortgage payment is only maybe $50 more a month. Especially with times right now, building savings is so important because again, there's a lot of unknown, and there's, things are a little more expensive. So by building savings allows you to tap into that when you need it. And even, for example, one of our big things that we offer is a home equity line of credit. So home equity line of credit, what that is, it allows you the equity in your home on a line of credit. So we have and every bank will have it called differently, but ours is called the all-in-one. What the all-in-one is, it's a home equity line of credit, and it can be integrated with your mortgage. So let's say, for example, you own $1 million home and you have a $400,000 mortgage. We can add a home equity line of credit with up to 65% if there's no mortgage, or 80% if there's mortgage and line of credit. So, but being able to add a home equity line of credit gives you access to your equity at a very lower rate compared to an unsecured line of credit, because a home equity line of credit is a secured line of credit, which is secured against your property. So it's a much better rate. And it just this is there as a safety net. So it's a good way to access your equity, leave it available. If you have it available, you're not going to pay anything. You only pay based on a balance.
That's a really great safety financial tool that I'm sure that a lot of your customers are taking advantage of. Are there other tools available to engineers and homeowners that can help them proactively manage their finances as interest rates flux and the mortgage payments may become a concern?
Yeah, for me, the best, and again, working with engineers is I always desire, because one, we offer a program for engineers. What this is preferred rates. So we actually, for your home equity line of credit rate, your standard rate is going to be prime plus a half. That's normal across the industry. With engineers, we're able to offer a professional package of prime plus a quarter. So it's a quarter decrease versus a regular customer. What our program is, it's, you get the home equity line of credit rate at a desired rate. Even for example, a mortgage, if you don't need the home equity line of credit and you just need a mortgage, we're able to leverage your profession to, try to get you a preferred rate. It also comes along with a requirement of a bank account. We offer up to 3 free bank accounts for the clients if they have an engineering job or a degree. So they can open up one of those at no cost, and then they would be required to take a MasterCard as well. And there's a few available depending on their needs. But this is a great program, and what I like about it too is the rate's lower than a regular customer, which also means for me the qualifying rate's lower. So I'm able to qualify an engineer for slightly more mortgage or home equity line of credit because I'm lowering the rate compared to a regular customer. So it's a great product and tool, and to be honest, it's one of our better professional packages. As we have a great relationship with engineers at National Bank, so it's a good thing there. Even on that, there's other things. To me, again, it always comes back to being able to have savings. We can always set up systematic savings, right? So if we know, you're comfortable putting aside $200 a month, we build a systematic savings account that, have this withdrawal from your salary account comes, into your account, and that builds a safety net as well, right? So there's a lot of things we can do based on your needs and building you flexibility.
Well, that's great that exists for engineers. Are there any government programs or incentives available in Ontario or nationally to assist engineers and homeowners in dealing with financial challenges posed by these rising interest rates?
Yeah, so it's not so much geared towards just the engineer, but there's a lot this government's trying to do to help. And the biggest thing that's been rolled out this year is the First Home Savings Account. So you'll see it referred to as the FHSA, First Home Savings Account. So National Bank was actually the first to roll it out, and it's not a National Bank product. It's just an account type. So it's similar to like a TFSA or an RSP. It's an account type that allows first-time home buyers to save and have benefits from a taxation perspective. So what I like about it is National Bank was quick to roll it out. It's available at all our branches. Like, for example, some other major banks are slow to roll it out, but it allows you to put up to $8,000 into the savings account per year, and it limits out of $40,000 total, lifetime. But the benefits of it is, first-time home buyers can, put money in there, and it's tax deductible. So whatever you put in is going to come off of what your total income is at the end of the year when you do taxes. So that's similar to an RSP, but the difference between an RSP and an FSA is there's less requirements. So our RSPs, if you put your money in an RSP and you're pulling it out for a first-time home buyer, it has to be paid back over 15 years. This new account, the First Home Savings Account, doesn't have to be repaid back. So it has a lot of benefits of the TFSA, but it has the tax benefits of the RSP. Even so, like, for example, you put funds in there in the new account, you can pull that out right away. For an RSP, you have to wait 90 days from when you contribute. So for any, young or first-time home buyers looking to build up savings, it's a great tool, and I'd be more than happy to help there. But it just allows you to do some things there to build up savings, have it tax deductible, and even, for example, any gains or income you make from, whatever it's sitting in, it's all tax deductible, similar to a TMSA.
That sounds like a really great tool for saving.
Yeah. And even for other first-time home buyers, there's other, government incentives out there. So for example, the land transfer tax refund is one of the bigger ones. So it's a rebate up to $4,000. So if you're a first-time home buyer, make sure you let your lawyer know that you're a first-time home buyer. There's a rebate up to $4,000. Let's say, for example, I'm a first-time home buyer and I don't know, my dad's going to help co-sign, who's not a first-time home buyer. Because there's two of us and only one of us are a first-time home buyer, you're only inclined to 50% of the rebate. So in that case, you'll get $2,000 back. But it's these conversations to have with, mortgage specialists like myself to get ahead of, what are the total of my closing costs? What are, what can I do to help because I'm a first-time home buyer? Maybe I don't know so much. So again, the government's trying to help these first-time home buyers enter the real estate industry. There's some challenges, of course, with prices on the rise and all that good stuff.
Wow. Matt, we covered so much ground today. Thank you for taking us through the intricacies of the different financial tools that you provide through National Bank. Is there anything else to sum it all up that you would like to say to the engineers in Ontario?
Yeah, no, absolutely. So my biggest advice right now is start early. So what that means is, let's say your mortgage is up for renewal in 4 months, 5 months, start early. So with rates, we can hold a rate up to 3 months and 6 months. So, your rate's going to be a little better when we have a 3 month hold or 6 months hold. But still, based on what we've seen over the last year, rates are constantly changing. And for example, you're starting early. This allows me to see different times of the year where maybe there's a dip in rates, or maybe, for example, we have a latitude that we have to keep our rate in. Maybe there's a dip in our latitude where we can get a little bit extra off, the rate than what it is a few weeks ago. So for people just kind of calling saying, hey, I close in my mortgage up for renewal in 3 weeks, or I'm buying a house that closes in 3 weeks, most likely whatever you're getting off the get-go is what you're going to end up with. But if we have a little bit of time, I would say anywhere from the 3 to 6 months is when you want to start. This allows us to kind of get something locked in. Let me allow my time to chip away at it and see if I can lower the rate. And building a relationship with you is important as a customer. If I'm able to start a file, I get to know you, I'm going to get attached and try to help you as much as I can. So, if we have something started, it allows me to kind of see where I can help you within my hands, right? So if you're just shopping around, calling every bank, what's your best rate? You're most likely not going to get it. And my advice is work with multiple lenders. It doesn't hurt. I mean, I would love to help everyone at National Bank. Sometimes they may not qualify, or maybe there's a different timing. They get a better offer because they started earlier. But working with maybe 2 or 3 mortgage specialists, in my opinion, is the way to go. You're able to kind of look at what your options are, look at different rate options. And why I really enjoy working with National Bank is it's given me a lot of latitude to win over business. So I would say we're a major bank. We're a top 6 major bank, but I would say we're top 3 with rates. So there's not many times in the year where I'm going to lose, business to, another major lender. So that's where I kind of have the expertise of just building out my, the number of files, the number of customers I talk to, seeing where I can get things done. So this year has been very, not everything fits in this perfect box of qualifying. It's how do we find exceptions? What is the exceptional part of the application for us to give you financing beyond what you qualify for, or get a rate beyond what, what our standard is? So that's where I've kind of built up the expertise of know where to push on files and get things done and, find a win for the customer.
Wow, that sounds like some great advice. Matthew, thank you for sharing your time and expertise with us today. It's clear we're going to have to live with a certain amount of uncertainty for a while when it comes to interest rates, but with a little strategic planning, engineers can not only manage that uncertainty, but continue to engineer their financial future. Once again, thank you so much for being with us here today.
No, my pleasure. And again, thank you for having me. And it's, I'm happy to help where I can.
We've been joined by Matt Pickering, Mortgage Development Manager at National Bank. I'm your host, Jerome James. You've been listening to Engineering the Future, and we'll see you next time.
From all of us at OSPI, the Ontario Society of Professional Engineers, thanks for listening. Please be sure to subscribe so you don't miss an episode.